Think back to the year 2000. The internet was poised to revolutionize the world, and investor euphoria reached a fever pitch. Four tech titans, Cisco, Dell, Intel, and Microsoft, dubbed the Four Horsemen, dominated the market. They seemed unstoppable. But then the dot-com bubble burst. Trillions of dollars in investor wealth vanished, and stocks like Cisco plummeted nearly 80%, driven in part by their reliance on customers with shaky business models. Now, 25 years later, history could be rhyming, if not repeating. Today, giants like Nvidia, Microsoft, Meta, and Broadcom account for nearly 60% of the S&P 500's year-to-date gains, as of Q3 2025. This extreme concentration is reminiscent of the dot-com era's peak. So, the question on every investor's mind, are we living through another speculative bubble? Or is it truly different this time? Welcome to the Microcap Brief. The AI bubble debate? The debate over a potential AI bubble is intense. The argument for a bubble is compelling. Valuation multiples are sky high, and we see familiar signs of froth. Companies get bid up just for mentioning AI in press releases, much as .com did 25 years ago. Even industry leaders are sounding alarms. Sam Altman, CEO of OpenAI, remarked in July 2025, "We're seeing betting on AI infrastructure at a pace and scale that feels unsustainable." Recently, the Bank of England joined the chorus, warning of excessive optimism in AI spending, August 2025. A Bank of America survey from September 2025 found that 54% of fund managers think AI is in a bubble territory. Is this time really different? Here's the key distinction. Today's tech titans generate massive free cash flow. The big players at the heart of the current surge, call them FANG Plus, collectively pull in hundreds of billions in annual operating profit, fueling buybacks and dividends. That wasn't true in 2000 when the Four Horsemen relied on unprofitable startups as customers and many winners were burning cash. Still, a reality check. Wall Street expects roughly $400 billion to be spent on data centers and AI hardware in 2025, but AI-related revenue is projected at only $60 billion. Not all investments pay off immediately, but the gap is worth noting. How to invest wisely. So, how should investors approach this landscape? When a gold rush is underway, the safest money often comes from selling the shovels, not chasing the gold. In today's world, those shovels are electrical hardware, cooling systems, and specialized networking equipment, the critical infrastructure behind AI. For example, companies like Eaton for electrical, Arista Networks for networking, and Johnson Controls for cooling are positioned to benefit regardless of which AI applications triumph. Above all, do your own research. Markets don't move in straight lines. Even the best trends can correct sharply. Stay vigilant and invest with discipline. Takeaway: the AI wave is real, but so are the risks. By focusing on the infrastructure fueling innovation instead of the flashiest headlines, you're better positioned for long-term success. Invest wisely.